Hi, it's Harry on February 26th. Very interesting time right now. The March newsletter, HSN forecast about to come out on Monday. Stocks have been going up again, but there's finally running into rising interest rates. This is what happens. It's the opposite side of, okay, you stimulate the economy by buying bonds and pushing down rates, but then it grows enough that you start to get inflation, or at least inflation expectations, and put that in quotations because it never seems to follow through. And rates go up, and higher rates, especially on the risk-free 10-year treasury bond, are not good for stocks or real estate and financial assets in general, and we're in the greatest financial asset bubble in history. By the way, just an estimate of the update of what I now call the most important number in the world financially, $525 trillion in financial assets, stocks, real estate, bonds, that sort of thing. Okay, so this is 6.5 times GDP. I always stress that okay, we have 281 trillion in debt now, which we'll show in the newsletter, and that's 3.3 times or something global GDP. And of course, that money can disappear when debts fail, but financial assets fail a lot faster and are now a lot bigger in comparison to the economy than any time in history. So that's the big threat here. So all it takes now at this point is a stock crash of any significance to throw the economy into question and have a recession, and then everything rolls down there from there, because 525 trillion means that at least 200 to 250 trillion, 40 to 50% of this is going to disappear, just like it did in the early 30s. We're not talking government debt here. We're talking the financial assets that do deflate, even though government debt goes up in downturns. So we're at this point. The markets actually do look like, and I'm going to show a chart that I put out recently in an update to our subscribers, and we'll repeat it again in the March newsletter. A very interesting pattern that looks just like, almost exactly like the pattern coming into the February 2020 top when the COVID threat hit. And that says, if we break down just a little more here, it peaked around 3950 on the S&P 500. We got down to almost 3,800. That was a good sign. Closed below 3,850. That's a good sign. But we need to see a sharper break, and that could happen just ahead. And interest rates, treasury bonds. I waited and finally gave a solid buy signal for people to start buying treasury bonds, emphasizing the 30-year that has the most leverage for playing deflation. And then I gave that at 1.26%. We finally hit that. It took so long. And now they've just gone through it. So they're at about 1.46% today. Got a teeny bit higher. There is resistance now. And every article I now see in the financial, but now inflation and is only going to go higher. I'm also going to show in the March issue, there's a chart showing how oversold treasury bonds are. And the last time we got this oversold was in late 2018, and we fell from 3.16% 10-year rates down to 1.5%. Huge rally in the treasury bonds, and this is slightly more oversold now, and equally to late 2016. So this is actually saying that it's more likely that rates are peaking here, but they may go a little higher. Not there is resistance at 1.5%, where we had the last crash into, I just mentioned, in rates, in bull market and bonds. So I think we're on the verge of a bull market in bonds. And of course, that is the safe haven. I just said, for people, I hope, who many caught it, debate with Jim Rickards, who I like, in the gold bug inflation camp with GoCo Group in Australia. And that was a very interesting debate. And, he's saying gold is a safe haven, and most people, and I'm saying no, it is the 30-year treasury bond is the best place you can be to play deflation when stocks crash, okay? So I think we're near that point. So I know the news is saying otherwise, and hey, if rates break much above this 1.5 or 1.6% spike it had literally just for minutes, then we may go higher. But again, this chart of how oversold treasury bonds are telling me this rate rise is likely over. I'm just hoping stocks finally start to break and then that builds on itself. So I'll be giving a lot of updates to our subscribers in the days and weeks ahead. We are at a critical point. This is the first time I've seen in a while that could be a top, but we need to see follow through to confirm that. So again, thanks for listening.